Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights to help boost your trading potential. Coming up, U.S. markets holding near record highs, but Japan stocks are stealing the spotlight, even stronger gains. Plus, silver miners are also shining. The metal prices continue to climb. We're going to take a closer look at an ETF riding that wave. And our trader debaters, they're standing by with the bull and bear cases for Johnson & Johnson. We're going to dig into both sides. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Trading day. Let's check on the S&P 500. It is modestly higher, but this is a market at record highs, despite the fact that the U.S. government shutdown has entered its 7th day. No official data out there. Probably going to take a close look. We always take a close look at the Fed minutes when they come out, but tomorrow's Fed minutes might even be more important. And you've got gold in this environment above $4,000 an ounce for the first time ever. Let's check a look at the heat map, see what's moving out there. AMD was standing out to me earlier. It's not taking up a lot of real estate on the screen, but up another 5%. That big jump for the name yesterday. Of course, it's got that partnership with OpenAI, the people who bring you ChatGPT. So still a lot of excitement in the AI trade. And NVIDIA, it sort of lagged yesterday because it wasn't part of that deal. It's up modestly, about 1.7% today. But across the rest of the screen, we have a fair bit of red holding us back from a better showing. Let's take a look at Dell. Dell Technologies coming out today, boosting their growth estimates for sales and profit. They are citing demand for artificial intelligence products. So there you go, AI trade again. They've got a new long-term financial framework they just told us about. They think sales will rise about 7 to 9% annually for the next 4 years. And earnings per share, they think an increase of 15% or more. So you got some excitement around the name there. You can see at the open, although it's come off the highs since we've been trading for the past half an hour. Constellation Brands, you may know Modelo. Drink it from time to time. They are the owner of that beer. Laura, they're reiterating. They had a low full-year guidance to begin with. They're saying, yeah, it's pretty much going to be what you get going forward. Macroeconomic headwinds, they say, sort of tamping down consumer demand. But they still managed to beat Wall Street's estimates for revenue and earnings per share, so the stock got a bit of a boost on that. And that's your market update. All right, time for another show here in Amin. Jason Nadek are with me here from our TD Direct Investing team. We also have some special guests in the studio. The Direct Investing team interns joining us today. Thanks for being here, guys. Hope you're going to enjoy the program. You can give the silent thumbs up during the whole show to make us feel good about what we're doing. But, you know, if you don't like it, you can also give the thumb. You're like the emperor. You're like the emperors, right? So dig in and enjoy the show. We'll get going here. What do we got? We want to do a little bit of a technical take on what's happening out there, right?
Yeah, let's kick it off, Greg. We're doing the silvers. Silver miners specifically is what we're looking at. The ticker I got pulled up on my chart is SIL. So this is the iShares Silver Miners ETF. This is basically gives you broad range of access to silver mining companies. It tracks the Sol Active Global Silver Miners Total Return Index. So there's about 33 different stocks that make it part of it. 65.3% of them are Canadian, in fact, as part of this ETF. Now, why are we talking about it? Well, because we know, you mentioned off the top, gold's obviously hitting new records. When you look at the gold to silver ratio, they kind of, silver had to do a lot of catch up, and at this point, it's kind of caught up to that at some point. But it also acts as the safe haven, similar to gold when, you know, times are uncertain, and also when you have inflation and currency devaluation as kind of the themes for this year. One other thing that I wanted to mention was when we're looking at the miners specifically, we see the miners sort of lead the actual metal itself, the white metal itself, when it comes to performance, especially during bullish markets that we kind of what we tend to have. But the action that I wanted to bring on the charts right now, and let's focus on that right now. So this is actually a weekly chart that I have. So each candle is a week representation. One thing I just wanted to note first was we saw that these miners have been knocking at this key resistance level, which is sitting about that $52 level. See, it knocked on the door, wasn't able to break and confirm, came back down. We saw it happen in early 2020, then 2021. But finally, we had that big breakthrough. It just broke through that $52 barrier over here. coming off of a long falling wedge and on this long sort of new bull run that had started over here. But then as we saw like midsummer, somewhere around like June to July, we saw this big spike up that happened with the silver miners and silver in fact. And this was in fact, we know that silver isn't a product that actually gets mined. It's almost like a byproduct of these other metals that get mined. Now, why we're seeing this sharp sort of squeeze, it's almost like a short squeeze like trade that's happening over here, is just with the sort of resources that are there with silver, and we know there's a big demand from India, in fact, buying a lot of silver. And then the Chinese players that were entered the market, they were on Golden Week, I believe is what their holiday was, so they were out of the market. They just returned this week. So we're seeing actually a pullback after what was notably, we're looking at almost like a full 5 to 6 weeks of green price action here. So this is one to keep in action. I am looking at a bit of a pullback coming back into this territory, but here's the line we want to hold at that 68 level right now. Just if it can hold below that previous low, we should still see this momentum carry on there.
All right, great breakdown on silver. They call it the poor man's gold sometimes, but it's making some big gains. Also, lots going on in Japan right now, and not only the politics, the markets as well.
Yeah, and it's all kind of tied into it, so we'll kind of dissect that for you. So the one we're looking at, the ticker is EWJ. This is the iShares MSCI Japan Index ETF here. So obviously this index, gives you exposure to large and mid-cap Japanese companies. The top three holdings are ones we are familiar with: Toyota Motor Company, Mitsubishi Financial Group, and Sony Group, of course. But they rallied into yesterday quite significantly, almost a 4.75% move, which is the biggest percentage gain since April 10th of this year, which the Nikkei closed at record highs, in fact. Now, this is on the backs of, we saw that, when the yen moved inversely yesterday, because of the nature of the export-driven, stocks that they have as part of their marketplace, and of course, bond yields spiked. And this is because Sanai Takaichi, I hope I said that correctly, dubbed Japan's Iron Lady.
He was practicing earlier.
We were practicing earlier, so hopefully you got that. She's to become the first female Japanese prime minister, but what's important for the market is that she's considered to be very dovish, pushing for more spending, tax relief, and of course lowering the interest rates. So much in the mold of her predecessor, Shinzo Abe, for his Abenomics. So what this means is that to generate these funds, they've got to sell more bonds, and that's going to add pressure to the long end of the curve as well. We saw that spike up. And that also explains, when you're running looser monetary policy and expansive fiscal policy, that's also going to possibly further stoke inflation worries that we have here. So when you look at this, it's had a bit of a storied run. Again, we've got the weekly chart pulled up. We've seen the consolidation take place between 2024 leading into 2025, and then we've gone on this sort of run. This upper trend line, this bullish trend line, is very much respected right now. Almost the 21 or the 13-week or the 3-month is now acting its dynamic support, which lines up right over here. So we might see a bit of a pullback, but this is where the resistance or support level is at the moment right now. We're looking at that 82 level on the Japanese play if you're looking for the EWJ ETF. That's where you want to see it test. But right now, we've just formed a bearish candle here, but it's still above that previous high, still holding that gap level. So we should see if it still continues on with this momentum.
You said Sony's one of the big holdings in this ETF, right? I was going to ask our interns, you guys know what a Sony Walkman is? No, and Sony Discman even?
Oh,
I had both of those.
They have no. I didn't think they would. That's the way that we used to listen to music a long, long time ago. All right, Jay, you've got something they probably have heard of: artificial intelligence chips, AMD.
You got that right. So you did a nice spotlight on that off the top of the show. I thought it maybe add a little context to why that big pop everyone saw on the AMD chart yesterday. So Monday, big substantial move upwards. This was all due to a partnership with OpenAI. They've reached a deal, and OpenAI is going to be acquiring, we'll call this several data centers worth of their, let me make sure I get this right, their MI45 chips. And OpenAI actually has a kind of now an outstanding agreement to acquire up to a 10% stake in AMD as well looking forward. So that's kind of interesting news. Many are seeing this as a play for AMD to close the gap on NVIDIA. One of the things here is that they haven't announced the cost of all these chips that they're getting, but it's expected to be in the tens of billions of dollars. So we're not talking pennies here. We're talking big dollars. And OpenAI has obviously had a partnership with NVIDIA. That $100 billion partnership, it's not actually been locked down yet. This deal actually seems to be much more firmly in place, and regulatory filing is expected to be announced very, very soon on this. But jumping to the chart, let's see that. So the big pop that we saw in the chart, we see that it's achieved kind of like 19-month price highs, so it's a big pop up. The stock had been trending upwards in a kind of a nice orderly fashion. After the big pop up, though, we did see some kind of some expected selling off in the company. We've got some kind of pretty significant resistance points on the way down that I want to be keeping an eye on. In technical analysis, we'd like to look for round numbers. $200 is kind of one that it bounced off of yesterday. We've got a positive open here today, so we'll see if we can continue to see some upward rallying. Otherwise, if we can see that selling pressure begin as after we saw the pop, we're looking we're looking back towards those the upper end of the band that we were at previously, and then the gap is the potential looking to be filled in if there's not more buyers stepping in with this. But lots of movement, lots of dollars, obviously lots of eyeballs on this space, so we'll be watching.
Very interesting stuff, guys. Thanks for that. And if you at home have a question for our team, here's how you can get in touch with us. Just email tdactivetraderlive@td.com. And for more information about that Active Trader platform or this Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website where you can try out the platform risk-free. Just open a practice account by clicking on the Try TD Active Trader button. Then when you're ready to switch to a live account, you simply export your workspace, start trading for real. Time for the main event, trading, debating. This week, the stock in the spotlight is Johnson & Johnson. This is a global healthcare company. It made famous household names like Tylenol, Band-Aid, Neutrogena, has since spun them off in recent years, but it made them famous. Before we get to our debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors, and significant losses are possible. So it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Back to the stock of the hour, Johnson & Johnson. What made us pick this one to debate? Here.
Well, J&J has been sort of top of its game. It has a storied history spanning over 139 years. As you mentioned, they were previously famous for their former healthcare fame brands, which is now under Kenvue, Listerine, Visine, Tylenol, of course, who can forget that, and their namesake, which is Band-Aid, of course. Mm-hmm. But also what the news is, with pharmas being slapped with, potentially, I should say, slapped with a 200% tariff. Right. A lot of these pharma CEOs are paying pilgrimage to the White House to see what they can do to it. So it'll be interesting to look at what J&J's has in store for their coming quarters.
Bull, little bear in there on this setup. Yeah, I was thinking he's leaning one way, but he went the other way, so I still don't know which was which. What excites you here?
So this is one of two companies, including Microsoft, that still maintains like AAA credit rating in the United States. And coincidentally enough, they've actually have. Even though these CEOs will be beating a path into the White House, they actually have higher credit ratings on their companies than the U.S. government does at this point in time. But forecasts could be rough on the company, so we're looking to see if prescriptions will be able to keep them out of, maybe I'm not I'm showing my hand a little bit here.
Yeah. Who's the bear? I think I figured out who the bear and the bull is here. All right, we got some time on the clock. I got a bell on my desk. I didn't check it before the show, so that was my little check. It is working. 2.5 minutes to make your case. Get some time to counter. You guys draw from the hat, and Jason is the bear. Why don't you kick things off?
All right, so we know they've already we spun off Kenvue. We talked about Tylenol. So even in a big bull run like Johnson & Johnson's in, avoiding the negative news around kind of the administration, kind of focus on Tylenol was probably a good thing. But there are some definite reasons, even when a stock is moving up quite substantially like Johnson & Johnson, while we might look to think maybe take a bit of a bearish stance on this, and the bull run won't be indefinite. So there's three things that are kind of jumping out to me. One is around some legal troubles that they've been seeing themselves very recently in. We've got patent expirations are a big thing, and weakening cash flows, kind of all stemming from the top two things. So the first thing, legal troubles. Long drawn-out battle over talc in baby powders that Johnson & Johnson is facing. There's been a recently rejected $9 billion settlement, and Johnson & Johnson is facing 67,000 active lawsuits in federal litigation, with thousands more at state courts. Johnson & Johnson has been accused of acting in bad faith when they're talking about settling these, trying to have their subsidiaries claim bankruptcy. So this is not something that's working its way through like public consciences in a positive light for them. And there are concerns that much of this litigation actually is their losses aren't in the provisions, because many of these are coming from jury trials. So we don't know exactly how this is going to go. So a string of big settlements and bad results might really impact the bottom line. Moving on to patent expirations, one of their big drugs is Stellaris. their patents. We've got some of the knockoff brand drugs they're beginning to hone in on them. Sales have cratered. They used to be around $11 billion back in 2023, plunging $1.2 billion year over year, and we're seeing quarter after quarter. Oh, we're getting there fast. But it used to make up 12% of 2022 sales. And cash flow, that could be stemming from that. We can come back to that later. I do want to make sure we get ourselves into the chart. I've got a long-term chart that's up here. This is a 5-year weekly candle. We can see that it's certainly had a bull run, but some of the things that I want to zone in on are what's happening more recently as we popped over to fairly significant resistance points. Looking at more of a 1-year chart, let me get that up on the chart. There's been signs that we can see that the prices have been starting to weaken. Let me zoom in a little bit farther. We can see the prices have started to weaken. There's 2 candles in particular, the doji candles. These are long wick candles with very narrow bodies. Those are exemplifying there's indecision in the market. And in compiling that with long upper shadows on these candles, we can see that markets are selling off from the daily highs. But there's 2 other specific indicators that I want to bring up on the chart to really kind of put this in. I've got the RSI and the money flow index at the bottom. These are both tipping into, they were overbought, now back into the regular zone. There could be some selling pressure on the way.
There you go. Let's not sustain. All right.
Yeah.
Boom. That was the bear. What did the bull have to say?
All right, so I'll counter to some of the points in the rebuttal that Jay made, but what I'm going to start with the case is, in the world obsessed with the next big thing, Johnson & Johnson reminds us about, trust, longevity, and reliability. 139 years, of course, have got, backs that up, and that never goes out of style. And if you think about healthcare is essential, aging is inevitable, and stability is undervalued, then Johnson & Johnson isn't just a stock, it's part of a long-term prosperity for your portfolio. There we go. But let's start with the dividend aristocrats. We talk about dividend aristocrats. These are companies that have raised their dividends and have consistently paid their dividends. But aristocrats only do it for 25 years. In fact, Johnson & Johnson is a king, because they have over 60 years. Now, anything that's defined as a dividend king is paying over 50 years with raises plus consistent dividends. They've done it for 60 years, over 60 years. This would mark their 63rd year, in fact. Their dividend growth rate over 20 years is at 8.01% as well. So when you take that into account and we talk about cash flow a bit, they've got enough padding there to keep their investors, keep them invested with the dividends, then give them return of capital there. Also, when you think about, let's talk about the pharma pipeline. So we know this business is all based on patents. Patents are a big key part of it, but they've got a diverse array of it. They've got about 13 brands hitting double digits. In terms of Stelara itself, which was their #1 sort of patent that they had, which is coming due for expiry.
1 minute.
They have Tremfya now that's going to take over, which is treating psoriasis, ulcerative colitis, and Crohn's disease and IBD. What's important about this is Stelara, 75% of prescriptions were for IBD, and Tremfya also covers that, which means they've got, they're projecting 4 billion sales right now, but they're expecting to ramp up to about 10 billion annually. Let's go into the charts over here and let's look at it. We've got the weekly chart that I pulled up to start with a sort of bird's eye view, zoom out view of Johnson & Johnson. We saw it come out of this big falling wedge, just finally broke out of it over here. Now what's key over here is this resistance that was previously there. This is the all-time high previously back in 2022, about the 186 mark. It just broke through that right now. Now what we do want to see is confirmation, where we want to see a follow-up in the weeks that it still continues acting as a new support area now for its next leg up here. Now I'm just going to switch for a second and we'll go on to the daily chart over here and we'll show what's taking place here, because there is a bullish flag that is forming over here, which I do think is going to present the next leg up here.
Do you notice how they took the chart down on you as well? So you kept talking. They pulled the rug out from underneath you with your time.
I'm going to have to bring that back up.
That was my move. Just talk as long as they'll let me.
And then they kept it up for you.
I know.
You got 3 minutes to counter, though. You can use the platform as much as you want in your counters. I think Jay should get the first word.
All right, you put a lot of emphasis on dividends, and let's jump back to the weakening cash flow here, because it saw declines of over 17% year over year, which equates to $6.2 billion in 2025. Even with, revenue is depreciating, cash flow is depreciating, revenue growth is staying strong, but when we think about dividends, how that was one of your big selling features, their dividend payout ratio is now 69%, so if we start to see that creep any higher, there might be some concerns, and when you've got
there's still a lot of room for it. They've never had it. On the average, they were at 75 on the previous quarter.
When you've got these dividend investors that are focused on dividend, when you start to see some price fluctuations in in the actual price if we get some pullbacks?
How many times have they missed paying the dividend?
They've not missed paying the dividend. But
139 years when they went public, 63 years of consistent dividend payments. So the payout ratio, it fluctuates from quarter to quarter. We agree, but it's not going to be any risk to them not paying it out.
And part of that too is that, like, over the last 2 years, we've seen astronomical increases in the debt that J&J has been holding. We've seen gone up from 16 billion to in just a matter of a year up to doubling up to 32 billion. So where's this cash coming from? We know that the influxes are coming a little slower, and we're now starting to borrow more money.
Possibly, but they're not using that to actually pay their dividends. They're using that for R&D development. When you look at the gross margins of the business, sits at 69%, operating margins at about 18.8%. In fact, they're actually committing to improving the operating margin. Now, if you think about this, they're able to control their costs with operating margin. So even if they're taking on this debt and they're still able to service that debt and they're improving operating margin, which tells me they're growing their top line and they're also growing their efficiency with how they're doing this. So 300 basis points improvement on this year on the margin. So that puts us operating margin somewhere in the realm of like that 21% is what they're projecting to do over here. Even when you talk about guidance, let's talk about it, because they're coming out with earnings in about a couple of weeks' time over here. They actually came out and raised their guidance. So in this next earnings, 278 on the quarter is what they're expecting, 23.7 billion of revenue. But the guidance for full year sits at 93.2 billion, or within the range of 93.2 to 93.6, which is higher than street estimate at 91.4 billion.
It's also much higher than their fair market value that's projected for the company. Where the stock's sitting, in the high 180s, when fair market value is pegged around 172. And just quickly jumping to the chart, T, we've seen a big upward move in that. I've actually moved to a much smaller segment, looking for trading opportunities. This is a 15-minute candle. We've been able to see kind of a descending wedge, and with today's action, we've actually broken down out of that kind of reversal pattern. So we've seen quite a drop down. We'll look for confirmation on larger candles as we see fit, but that's one of those things that the trading signs are maybe saying they're showing this. We're running out of steam, coinciding with the RSI and the
Sure,
and the
you make a
MFI.
good argument with that. So what I will say is, looking at the charts, though, one of the big catalysts that's going to happen is similar with Pfizer, the deal that happened with the administration, with them getting a reprieve on their pricing, and that shot up the stock. We should see that coming up, which is why I've looked at the chart and I've said, even though resistance levels are there, we should see it push up higher once they make that deal come through.
You guys came ready to rumble. It's like we need a bigger bell. Like boom, boom, boom. They pull them back into the corners. Nicely done, guys. Nicely done. We've heard the positions. We've heard the rebuttals. We've heard the back and forth. Now, we want to talk about how you could possibly trade it through options in the platform. Let's start with the bear side.
Yeah, let's talk the bear side of things. If a bear is looking to play this trade, especially when we're trading into the trend, you want to make sure. I like to think about having a kind of a risk-defined nature to my trade. So when I think about that, one of the first strategies that comes to my mind is a spread trade. And in this particular case, I'm thinking that we could do a bear put spread. So we're buying a closer to the money put and then selling a further out of the money put to bring in a bit of premium to offset our costs. So we're limiting our risk on that particular trade, but we're still taking a decidedly bearish trade. So if we jump into the platform here, what I've got up on the chart is just kind of a visual description of the trade itself. So we have buying the 185 puts all the way out into December. We're buying ourselves a little bit of extra time. Even if the trend continues, we've got time to be right if we can get this pullback. And then selling the 175s to offset some of those costs. The purple line that I've got drawn on the chart this is our break-even point. So if we can get Johnson & Johnson to come back below that break-even point, that's where we're going to start being in profit, and we make max gain if we can get ourselves out of down below the 175 that we can see. So we've got time on our side. We've got, I know it's just one candle. We're looking to see more confirmation. It's something we preach about all the time in our master classes around technical analysis, and here on the show, we're looking to get confirmation, validation of opinion. But the trade I'm proposing here is a kind of a longer dated bear put spread, buying a 185 put out to December, and then selling to offset some of those costs, the 175s at the same expiration.
All right, so we got a line on the screen with a little box saying max gain of $7. What are we putting at risk here?
So we're putting at risk with at this point, this trade is costing us around $3.20. So that's $320 a contract. That's max loss when we're talking about any debit trade on an option. If this is absolutely a directional trade, so if it doesn't go down, it's one of those ones you're going to be losing that if it stays above 185, or if you don't sell it to close, if you've kind of had a change of heart through the expiration process.
Okay, how could a bull possibly play this one here?
All right, so we're gonna, given the backdrop of what's happening in the pharma industry and looking at the chart that I have here, I've got the weekly chart pulled up again over here, and the trade that a bull could possibly play is you're looking for a directional play. Is doing just a simple single leg call option. So buying a call option. The one that I've kind of eyed is, again, similar to what Jay had mentioned. Give us a bit more time for the stock to actually move in the direction we want it to. So we're going out to the January cycle. So this is about 101 days out till expiry, which is what we've got days to expiry here. It's this. It's the 190 call that we're looking for. Now the reason I've got the 190 call is because, again, this is sort of the tops of where the previous high was reached here. So this is a critical area that we wanted to break, and if it does break above this level, based on this flag, the pattern that we saw, this bullish flag, which usually tells us like what the measured move might be from the base of the flag up to the top of the pole there, it puts us in the realm of about that 210 level or so. So it gives us a bit of upside. Now this one is currently bidding. We did see it kind of pull back in pre-market today, but the option is bidding around $5.55, which is what our entry would be. So that means break-even price we need for Johnson & Johnson to get to at least $195.50 to just square our money back. Anything above that is going to be profit for us there that we're going to get.
All right, and you've now put that little legend box there on the screen to help me out. I think you did it last week for the technical take on Money Talk Live. Max profit, max loss, if we can pull the screen back up again.
Yeah, so max loss is essentially just because we're doing a single leg call over here, it's essentially the debit that you pay. So in this case, if we're entering it for $5.55 the premium, that's what we stand to lose. That happens, of course, if it actually doesn't get to the 190 level and by the time we hold a trade. Now, remember, we don't actually have to hold the trade all the way till expiry. We just want a bit of move, but 190 in either case if it doesn't get there.
Okay, thanks for laying out the bull and bear cases for Johnson & Johnson. A spirited debate. Just to remind our viewers that this spirited debate was for educational purposes, does not reflect our personal opinions about the stock. Before we move on, Jason, I think you were talking about the RSI, and there you're going to elaborate.
Yeah, well, now that we're putting out charts after the bell, I've got to
learn the legal loopholes of the show, right?
Exactly. So I'm going to take everything that's given and put my way here. So we're going to talk RSI. So that's the relative strength index. It's a momentum indicator that will plot on below your chart to kind of identify where a stock may be kind of running out of steam and might be showing overbought, or is kind of where that downward trend might be willing to or might be looking to reverse. Something might be oversold. You're looking for it to bounce back up. So it's basically over a range of time. It's looking at what percentage gainers and losers, and then dividing those together. So that's kind of what it's looking at. I'm going to show you how we can use it in the chart. We have a much more fulsome discussion in our master classes that we present in Webbroker. So come join us there if we're looking to dive in a little bit deeper. So we'll keep Johnson & Johnson up on the chart because it certainly benefits my discussion. But if we want to add RSI to our chart, we're going to go to the studies settings button at the top of the screen, and we're just going to do a quick filter. We can type in RSI. The acronym works just fine here. If we drag it over to the middle part of the screen. By the way, for anybody who's unfamiliar with a particular study and what it's looking to tell you, if you hover your mouse over the name of the study, the little question mark here, you want to make sure you understand what the study is trying to tell you before you actually act on its signals. So that's definitely a nice little hidden tip for you there. But after we close this out, noticing here that at the bottom of the screen, we've got a red line. That's the relative strength index itself. But we've got a teal line at the top and the bottom, normally set at 70 at the top. That's where a stock would go overbought if maybe momentum is running out. And you've got 30 at the bottom showing the oversold amounts. This is typically where you're going to be using in most markets. But if the stock is heavily trending and Johnson & Johnson is heavily trending, sometimes traders will widen these bands out to an 80-20 level. So maybe that supports Aaron's argument a little bit there. So equal opportunity here for this segment. And if you wanted to make
that was very generous.
Yeah, no doubt. And if you wanted to make those changes, just click the gear on the name, and you've got the overbought and oversold levels you can change to 20. The signal, which we're looking for confirmation, you're looking for is, in this particular case, you see the RSI is tipped up over the overbought, and when it's confirmed itself dropping down into the middle part of the study, that's confirming itself. That's one signal that traders look for before making their buys and selling decisions. All
right, interesting stuff. If you at home have a question about the TD Active Trader platform, or if there's a stock you want to see our debaters go head-to-head on, just send us an email at td.activetraderlive@td.com. More information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It takes you to our TD Active Trader Live website, and if you scroll down, you're going to find a tab that says Join a Live Masterclass. Well, this Wednesday, 1 p.m., our Jason Nadek hosting an interactive session about TD Active Trader. He's going to explore all the main features the platform has to offer So you're familiar with the tools you're required to trade and manage options with confidence. Registration is required and is open now. Show always goes by so fast. Before we wrap up, we want to pick your brain about some of the key things that you are taking a look at. What's on the radar?
Yeah, so this is a bit of macro. I guess, the government shutdown, we're not getting all the data coming in, but the one coming out, of course, tomorrow is the meeting minutes from the FOMC. So markets will really, again, scrutinize the tone and internal Fed debates that have happened, hawkish versus dovish, for clues on future rate cuts. But we more or less know who's in what camp and by how much at this point that's coming into it. So it's almost like, let's confirm that was the conversation that took place. The second thing I'm looking at, though, is, again, we're going back, starting up earnings season again. And the one I've got squarely in my focus is APLD, Applied Digital Corporation. So they're going to be reporting earnings after the close on Thursday. Expectation is loss. They're going to be reporting a loss, 11 cents, and revenue of $45.5 million. Now, what this company does specifically is they design and operate specialized data centers that provide high-performance computing infrastructure for AI and blockchain applications. Now, why are they in the news? Because they've, given this revenue, their CEO has come out and said that we hope to achieve $1 billion in operating profit in the next 3 to 5 years, which is quite a significant milestone. They also announced back at the end of July, or beginning of July, I should say, to a deal to provide 250 megawatts worth of data center capacity for a leading AI hyperscaler, CoreWeave. And so this will bring the anticipated leased contract revenue to roughly about $11 billion over the next 15 years. So, we talk about power and compute. Well, this is basically the company that builds these data centers and powers them up is what they're looking at. So let's look at the charts and see how they've reacted. The markets obviously bid them up. We saw coming into the summer, after going through this downtrend in June, they started this new leg up. This was on the news that they made that announcement with CoreWeave. We saw a big push up there. And then it's formed this cup and handle pattern over here. So this is usually a bullish sign that we're going to see a new leg up. This was a key demand zone where it was rejecting previously. And we did have that breakout, in fact, just happen just a couple of weeks ago in September. It's actually broken out of this wedge pattern now, and it's actually hitting new highs. Just rejected off this 29.30 level. We're probably going to see, in normal course of a bullish move, we should see a little bit of pullback happen, which is very natural and normal, coming back to the 25 level and then again resuming past that 29 level. So we'll see if the earnings is going to be a catalyst to get it past that 29.3 level.
All right, one to watch. You've got snacks and soda pop on the brain.
Snacks and soda pop. I got PepsiCo. They've got earnings coming up this coming Thursday after the bell. Now, reaction is decidedly mixed on a new Pepsi product launch. They've got gingerbread Pepsi and gingerbread Doritos. So if that's your thing, then maybe go look at the store.
Like the Pepsi you drink tastes like gingerbread.
Exactly.
You're breaking
not
my
ginger
brain.
ale, but gingerbread Pepsi.
You're breaking my brain.
Yeah, no doubt. So guess what? Consumers' reactions are mixed too, and they seem to be a bit mixed on kind of what to expect from an earnings coming up. Like I said, later in the week, expectations for earnings per share is actually down 1.7% to 227, but revenues are expected up by about 2.4%. So kind of not sure where to go with this here, but it might not be the fizzy drinks that are causing Pepsi's share price to slip 6% versus the broader S&P. Broader S&P is up about 14%, Pepsi down about 6%, so kind of definitely not a lot of correlation there. But it's actually the salty snacks that are causing some concern here. Volumes have remained flat, and consumers, and this is over the last 2 years, volumes have been flat, but consumers appear to be balking at the double-digit price increases. I know I've seen them. If you go to the grocery store, the chips are quite expensive here. And along with that, one of the big trends in the industry is protein-based snacking. It makes up now 13% of the snack aisle, only 1% from Pepsi's. So one should see if there's any changes there. But let's jump into the chart, because on the theme of mixed signals, we're getting mixed signals on the chart as well. We've got a cup and handle pattern, which Kieran just went into with his stock. It's a continuation pattern. But in this particular case, the stock didn't achieve its full measured move off that pop up out of the cup and handle. It rejected off of around 155, and now heading into earnings, we've got a pretty substantial bearish flag that's been demonstrated here, and the price is actually now at the bottom end of that range. So we've got very minimal time. So if we break down below that, any negative news out of earnings could see this pull back even further, back down to where it was early in the year, which were its lows around 127.
As you mentioning those new drinks made me think there's a whole thing in the industry now called dirty sodas.
Yes.
Have the interns heard of dirty sodas? Apparently, it's like adding like milk or cream to a thing. I
Cream,
said,
yeah, and then
that's
they
not.
put,
Once
like,
I figured out what it
condensed
was, like that's not new. It's like when I was a kid, you took 2 scoops of ice cream, you put a cork or Pepsi over top of it, eventually it all
Classic
melted,
float.
and you had float. So
Yeah.
everything old is new again. So okay, we found one point of common reference here with our young audience. Thanks for joining us, guys. I hope you enjoyed the show. That's all the time we have for the program this week. And we want to thank, of course, the team for being here. And on a quick programming note, this Thursday, we're not going to have a show, but we will be back to our regular programming schedule next week. That is a Tuesday show and a Thursday show. And as always, investors should perform their own due diligence before engaging in trading. Thanks for watching.